In this week's video, we'll review the latest charts and data to help us answer the question, is the NASDAQ an accident waiting to happen? We'll be moving quickly, so feel free to use the pause button on your video player. This is the chart of the S&P 500 that we covered in last week's video. During Friday's session, S&P was trading at 5206 here, upper left-hand corner of your screen. Fast forward a week later, approximately 2 p.m. Eastern Time, on Friday, June 7th, S&P is trading at 53.53 and up 76 points for the week. This is breadth data from the full session on Thursday, June 6th. This is the NASDAQ here, new 52-week lows, 117 relative to 128 new highs. But we should also take into consideration that in 2024, there's over 3,000 companies included in the NASDAQ composite, and thus, during Thursday's session, less than 4% of the NASDAQ composite made a new 52-week low. And we should also consider that on average, around 150 to 200 companies get delisted each year from the NASDAQ. There's a lot of turnover in that index, and a lot of extremely weak companies that can skew the breadth data. Doesn't mean this isn't relevant, but NASDAQ breadth data needs to be looked at in a different light relative to NYSE data and S&P 500 data. It's a daily chart of an indicator known as the NASDAQ Technical Index. It looks at advancing stocks minus declining stocks, calculated as a percentage of total stocks, volume of advancing stocks minus volume of declining stocks, calculated as a percentage of total volume, and then it looks at new 52-week highs minus new 52-week lows and calculates that as a percentage of total stocks. Somewhat similar to the concepts we just discussed over here. So this indicator, made up of 3 different kinds of breadth data, is relevant. Late 2021 over here, you can see if we look at the data, put some Bollinger Bands around it, you can see the data's hugging the lower Bollinger Band here. That's extreme weakness. Also hugging it right here in January of 2022. This is the NASDAQ composite down here, and we all know during the bear market in 2022, bad things happened. Contrast this negative hugging look here and here to the positive hugging look that we had late in 2023, and again, very, very recently in May of 2024. This and this in early June really don't look anything like this and this. In fact, this indicator that's made up of 3 different kinds of breadth data from the NASDAQ exchange recently printed a new high. When the S&P 500 peaked here in early January, the indicator had not made a new high for several weeks. If we put the same data on a longer-term weekly chart, you can see we have our hot knife through butter look here in 2008. This is the financial crisis, and you can see the breadth data slices right through that all-important 200-week moving average here shown in red. And if you know your stock market history, you know the stock market did very well in 2013, 2014, and into approximately May of 2015. And you can see the breadth data made a stand at a 200-week moving average in red that was turning up. So the data here, price in this instance, is this data here in a weekly format. So we can see this bullish period here really doesn't look much like the financial crisis. Very similar situation here. The S&P 500 corrects, bottoms in Q1 of 2016 here. Once again, the breadth data makes a stand at or near an upward sloping 200-week moving average in red. Even stronger in this window here. And this is the look in the present day. We have a clustering and turning up look in a positive manner. This really doesn't look anything like this financial crisis look here in Q1 of 2008 and Q4 of 2007. In fact, the present day here looks a lot more like this constructive turn in early 2013 and this constructive turn here in calendar year 2016. And the S&P 500 and the NASDAQ had a great full year 2017. And remember, we said based on the number of stocks in the NASDAQ and also the number of stocks that are doing poorly in the NASDAQ at any given time and the number that are delisted, the listing requirements are more stringent to be on the NYSE and they're more difficult to be included in the S&P 500 index. There's a reason why most breadth data looks at the NYSE. So this is NYSE new highs minus new lows. This is a much improved look relative to what we had in 2023 in here, and it's finally starting to move in the right direction, similar to the post-low in 2020 COVID, similar to the period after the Christmas Eve low 2018 into early 2019, similar to the look, we just talked about that low in the S&P 500 in Q1 of 2016, that was in February. Similar situation here after the low in 2011 and after the major low in March of 2009. This really doesn't look anything like this look here in Q4 of 2007 or during the period of weakness in 2015 into early 2016. So the moral of the story here, moral of the story here, here, and here is most likely this is relevant, but if bad things are going to happen, it's also possible that it will be a relatively muted pullback relative to a full-blown bear market. Now let's look at this data in a different format. We've covered this chart numerous times, including in Q4 of 2023 during the stock market correction. At that time, November 1st, 2023, we said this data, this chart, needed to improve. Well, that's all the way back into this region in here. This is the look on November 1st. This is that same spot. And it has improved significantly. In fact, this improvement in here looks like the period after the major low in 2009 over here, and after the major low in October of 2002, and after the retest in the spring of 2003. This and this a similar look to this. Another way to look at NYSE breadth data, NYSE advanced decline volume line. This is cumulative data, monthly. You can see a constructive look after the major low in 2002, 2003. Constructive look here. We cross above the 20-month moving average in blue after the major low in March of 2009. Similar constructive look in 2016 when we get that bottom in February of 2016 here, this and this and this, similar look to this, and maybe more importantly, this look here looks significantly different relative to what we had during the bear market and even to what we had in 2023. And when this, and this happened, good things happened in the stock market down here for several years. And notice in these cases, the stay below the moving average is relatively long, stay below is relatively long, relatively long. In this case, it was shorter. That's the COVID period. But it should be noted the rally in that instance lasted a little over a year, and then we ran into trouble again. But even if that's the case, we're still early in this look here. And it's very, very difficult to say that market breadth. Remember we said back in November of 2023 that we wanted it to improve. Here's November of 2023 here. It certainly has improved. This looks a lot better than all of this. Now we're looking at breadth data tied to the S&P 500. Once again, you don't have hundreds of stocks being delisted or removed from the S&P 500 each year. These are more stable companies, and hence the breadth data tends to be a little bit more reliable and stable. Here's the bear market in 2022 here. You can see prior to the kickoff of the bear, here's January 2022, the S&P 500 down here was doing well, but this breadth data for the most part was moving sideways. It's not what we have in the present day. S&P's been going up over here, bottom right-hand corner of the screen, and the breadth data has been improving. It is getting a little bit more narrow in here, and that's noteworthy, but this, making new highs in here, still looks better than this. And we're also holding a breakout above these levels here. If you want to look at it another way visually, you can use these boxes. Leveraged loans, risky loans. During the risk-off period, the COVID plunge, this is what it looked like. This is what risky loans looked like in 2022, and the S&P 500 is suffering down here. This is what the present day looks like. We're making a series of higher highs and higher lows. This really doesn't look anything like this, and this up here really doesn't look anything like this. Chart dated June 7th. It's the daily chart of the NASDAQ, June 7th, approximately 11 a.m. Eastern Time. It's the relative strength index down here. Looking at a daily chart and daily RSI. This is the weakness in momentum that we would want to avoid. This is what the present day looks like over here, much improved relative to the look in April of 2024. We also have price holding above this consolidation period in here, which started in February of this year. You can also see when the correction in this window was over, the center line on the Bollinger Band turned up. We have a similar turning up look here in recent weeks. NASDAQ Weekly, June 7th, 11 a.m. Eastern Time, up 438 points for the week, or up 2.62%, making a new weekly high, at least intraday. All of this occurring above an upward sloping 200-week moving average in red. At the end of the correction in 2023, you can see MACD in black tried to turn up above the center line. We have a similar turning up look. We'd prefer to see it finish out with some white space in here. Intraday on Friday, June 7th, we had a bullish cross with black back above red, but that needs to be nailed down at 4 p.m. today. Maybe most importantly, all of this momentum in here occurring above the center line, implying that this was a pullback or a counter trend move within the context of an existing uptrend. All of this activity, including this weakness in here in 2024, occurring above the center line, that looks radically different than dropping below the center line here in January of 2022. And this implies that you are in a downtrend on a weekly time frame. So market breadth has been weak. If we do see some weakness right now, it looks like it's weakness occurring within the context of an uptrend. Similar situation here. This is a weekly chart. This is CCI, or the Commodity Channel Index down here. This is the look that you would want to avoid. This is before the S&P 500 peaks. And as the NASDAQ is peaking in Q4 of 2021, this is the weakness in momentum during the correction in 2023, and this is what we look like on Friday, June 7th. This doesn't look anything like this, and this doesn't look anything like this. RSI is showing a little bit of a divergence in here, telling us to keep an open mind about a pullback in the NASDAQ. That may happen very, very soon. It just hasn't happened yet. And this look here, relative to this and this, would tell us it might be just that if it happens, a pullback. It's hard to get too concerned when you look at the chart of the NASDAQ, the daily chart on June 7th, and price is above the 8-day moving average in blue here. This is a constructive look, similar to this look in here after the correction was over in 2023. NASDAQ weekly cloud. If you look at the left side of the screen here in 2024, checking these boxes here. If you look at Q4 2021 and into early 2022, the polar opposite. In the early stages of the new downtrend and/or bear market, we are checking the bearish boxes as time goes on. Even what we have in hand on June 7th here looks quite a bit better than what we had during the early stages of the correction here. This is the 10% correction in the S&P 500, this window that took place in 2023. As far as a leadership change, away from the NASDAQ 100 relative to the Dow Jones Composite. It's just not happening. Dow Jones Composite underperforming this week by 2.58% and making a new weekly low down here, at least intraday on Friday. Very, very similar situation if we look at the same ratio, but replace it with the broader NASDAQ Composite. In terms of sector shifts, the Dow Jones Composite is much heavier in industrials, utilities, financials, and healthcare, and the weighting to information technology is quite a bit lower than the NASDAQ, which is about 50%. So it's hard to say that the market is shifting away from tech and growth based on the look of this chart and this chart. Not making any assumptions about what next week looks like. As always, the commentary is based on the chart in front of us. Kind of a mixed bag here, Dow Jones Corporate Bond Index. This is a constructive look with price above and consolidating above the 200-day moving average here. However, if we look at the 200-week moving average, it's been consolidating below it. And this makes sense because we don't know what the Fed's next move is. But what this chart really tells you, given the S&P 500 bottomed in October of 2022, compare this look to this look and this look from a timing perspective relative to the stock market, and it aligns with the concept that we've talked about numerous times in these videos that we're in a different world. This slide is from June of 2023, approximately a year ago. We're living in a different world. Hence why we're working so hard on the ongoing development of the secular volatility model. Economically sensitive travel and tourism. What once acted as resistance in here in 2021 may now act as support here in 2024. All of this above the box occurring in the context of an improving 200-week moving average down here. This is the S&P 500 down here, the lower panel. You can see the stock market does well in the blue box. In the triple Qs, the NASDAQ 100 in the ETF world starts to outperform gold here. Very, very similar situation when the correction was over in late October, early November of last year. You can see the ratio improved. This is the look in the present day. It's fair to say this looks a lot like this window in here. If you like the chart of gold, and this is June 6th, this is a constructive looking cup and handle pattern with a successful breakout currently above that bullish cup and handle pattern. If you like this chart, then really by default, you have to like the chart of the S&P 500 better. Why is that? Because the relative chart clearly is not favoring gold relative to the S&P 500. This is clearly still in a long-term downtrend, and the right side of the chart really doesn't look anything like this period in here where gold started to outperform stocks significantly. So if you think this looks good, it's very, very difficult to say that you don't like the S&P 500 at this point. Both charts dated June 7th. Both of them span from the year 2000 to 2024, and both of them have a red 200-week moving average. Similar concepts here intraday on June 7th. This looks like normal consolidation in the Dow above this base here. This isn't a particularly intimidating chart. It's a constructive chart. Thus, if you like the chart of the Dow, then you really have to like the chart of the S&P 500 even better, because the Dow is clearly in a downtrend and weaker relative to the S&P 500. Very similar concept. Chart of the Dow looks pretty good, but relative to the NASDAQ, it's weak, and that says a lot about the strength of the NASDAQ. 2024, or the right side of your screen here, really doesn't look anything like Q4 of 2021 and Q1 of 2022 in the early stages of the 2022 bear market. NASDAQ 100 intraday around lunchtime on June 7th, up 2.69% for the week. This is a constructive look on the right side of your screen. Compare and contrast the Present day, the correction in 2023, price comes down into the blue span here. We don't have that in the present day. This is stronger. And in this window here, the green span dropping below price in this window here, this is that transition from checking all of the bullish boxes to eventually checking all of the bearish boxes. This is late 2021 here below the big, larger red arrow. This is early 2022. Moral of the story, the present day looks better than the correction in 2023, and the present day looks significantly better than calendar year 2022. Covered this numerous times. NASDAQ 100 monthly cloud. In the past, when blue has crossed above red, good things have happened for several years. 2023, blue crossed above red, and we still have that holding, with the monthly chart hovering right around a new all-time high. NYSE composites similar to the Dow. If we drew a horizontal line here, we have a breakout. This consolidation is occurring over here above these levels here that acted as resistance in the past. What once acted as resistance may now act as support if we get weak. All of this is occurring above an upward sloping 250-day moving average down here in gray. The fastest moving average, the 50-day in blue, is on top. The slowest moving average, the 250-day in silver or gray, is on the bottom. Intraday on Friday, price was above all the moving averages. And once again, the chart of the NYSE composite, pretty good looking chart. It's not an intimidating chart. Still has a nice risk-reward profile, especially in the intermediate term to longer term. And this chart looks pretty good. And the S&P 500 looks even better. This is the S&P 500 relative to the NYSE composite. And we're using the exact same moving averages. The S&P 500 has a full-bore bullish look almost in here relative to the NYSE composite. And the NYSE composite looks pretty good on its own, telling us a lot about the chart of the S&P 500. Also noteworthy, the present day, the ratio relative to the moving averages really doesn't look anything like this transition to the bear market in 2022 here. The ratio is also holding above this breakout level here and holding above this breakout level here. Intraday, June 7th, semiconductors, economically sensitive semiconductors, up 3.21% for the week, trying to nail down a new weekly closing high. All of this occurring above an upward sloping 200-week moving average. There's really three things that you need for stagflation. We do not have two of them. We do not have high unemployment, and we do not have stagnant demand in the economy. Both GDP and earnings have been growing during Friday's session at approximately 2 p.m. Eastern Time. The weakest sectors were defensive-oriented consumer staples, defensive-oriented real estate, and defensive-oriented utilities. We can also throw in materials. Nothing particularly alarming about this sector look during Friday's session. This is the S&P 1500, 3 times larger in terms of the number of stocks relative to the S&P 500, meaning it is broader. In February of 2024, which is the larger chart. In a video earlier this year, we said this is a constructive look. This is a broad index and good things are happening over here in early February. And the S&P 1500 is still tech heavy because the economy is tech heavy, but the 5th largest holding in the index makes up less than 3% of the index. So it's a broad index. Speaks to market breadth. This is the concerning look here that we covered in November of 2023. You can see price is below all the moving averages, looks significantly better in February of 2024. And if we fast forward to the present day, intraday on June 7th, this is a weekly chart. Hard to get too concerned about market breadth when the S&P 1500 stocks approximately, is making a new weekly high or trying to nail down a new weekly high, and it's also consolidating in here above an upward sloping 30-week, 40-week, and 50-week in green. All of this consolidation in the upper right-hand corner of your screen is occurring above this previous area over here of resistance. Present day look of price relative to the moving averages really doesn't look anything like this scary transition here in the early stages of the 2022 bear market. The stochastic oscillator is on the bottom portion of your screen. We're looking at momentum in three different forms. The S&P 500 weekly on June 7th. Compare and contrast the look in the present day to the look in the early stages of the correction last year when the S&P 500 fell approximately 10%. The weekly chart drops below the moving averages here, and momentum drops out of overbought territory and gets weaker using all three indicators. This really doesn't look anything like this on June 7th. This in here really doesn't look anything like this. And during the correction in 2023, stochastic RSI weekly never could clear the center line. That happened after the low. We've cleared the center line, come back and tagged the center line here, and we're trading above it on Friday. Trying to nail down a new weekly closing high, and you've got price above both of the moving averages. Blue, the fastest moving averages on top. Red, the slower moving averages on the bottom. It's not what we have in here during the correction. Is it possible that momentum is about to weaken? Absolutely, positively, yes. That may happen very, very soon. We just don't have a lot of evidence that longer-term momentum is seriously deteriorating. How about the market? Is it getting defensive behind the scenes? XLP relative to SPY. You can see the defensive-oriented ratio is increasing rapidly from this low in November of 2021. This is where the NASDAQ peaked in here. So when the NASDAQ was performing poorly, the ratio was rising. It's not what we have over here. Look at the ratio relative to the moving averages and compare and contrast this look here to the look during the bear market in 2022. Right now, this looks like a counter trend move over here on the right within the context of an existing downtrend. Last week, we said our models looked constructive. If we fast forward a week, calculated during the session on June 7th, trend strength model still very constructive. Secular volatility model scores over here still very constructive, telling us that any intermediate term weakness would be treated as a counter trend move within the context of an existing uptrend. If the charts start to shift, we will have to reassess those probabilities, which means a chart like this, if this starts to morph into something like this over here, concerns would increase. Relative to the topics on your screen and relative to these bullet points, we are still working extremely hard behind the scenes, but we are making some excellent progress. And just as we thought, we've been learning as we go, and we're confident that this meticulous process and this meticulously built model will help us for years to come. We are currently not accepting new clients, but we expect that to change in the months ahead. If you're interested, you can contact us and we'll add you to the list. The bullet points on your screen provide a summary of the topics that we've just discussed, and we all know the only way that we can use any of this effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.